ladies and gentlemen. My name is Shae Russell and welcome to the Precious Metals
Investment Panel. Today we've got some people here joining me on stage who are going to help lay out the broad themes behind gold and how we can invest, or what are the actionable recommendations when it comes to investing in gold and gold exploration juniors. Now, joining me on stage today, we're going to start with Sagar right here on my left. He is a senior research analyst senior research analyst in the gold space from Mackenzie. In the middle, we have Andrew Haythorpe, who is the CEO of ECR Minerals. Now, ECR Minerals are listed on the London AIM exchange, and ECR is a gold explorer with interests in central Victoria, Queensland, as well as an epithermal gold project in the Philippines, I believe. Right. Then we're over on the corner, the far left, we've got Mike Spreadborough from the executive co-chairman from Toronto-listed Novo Resources, a gold explorer. Probably doesn't need much of an introduction to the Australian audience, with one of the largest prospective gold projects and battery metals projects in the Pilbara. Gentlemen, thank you for being here today.
Thank you, Shae. Nice to be here.
Now, we're going to start today's conversation about precious metal performance. Gold has retreated from the May high of $2,070 per ounce. However, even though it's back in the 1960s, it's still up about 8% for the year to date. Now, we were just talking before our mics were turned on about how gold is a fickle metal to trade, and its volatility with macro events makes price forecasting a fool's errand. But tell me, gentlemen, we're going to start with Sagar on my left. How do you see the price movements for gold for the second half of this year?
I think price has remained very well supported since the mid of 2019. And there have been multiple reasons for that, starting from the US-China trade war. And I think gold has got support time and again. That's when I think it started moving upwards. Then we had, COVID. Then when COVID got slightly settled, then we had a new variant for COVID. Then when that got settled, we had the war. Then when that got settled, we had inflation. So if you see, there is so much going on. Then you have the US debt crisis, some banks that failed, in the recent past. And then the latest is now that the US might default on its treasury bonds. And then again, we have inflation back again. So we see that this kind of, to put it in a very crude way, I think the world is getting a slightly riskier. So we see continuous, focus on gold, and I think the price will. We are estimating price at around 1900 for the year, and I think with gold the thing is that it's not just a metal that's driven by supply and demand fundamentals. It's actually also a currency. So that's very it really moves on the basis of a lot of macro events and the investor sentiment.
Andrew, I'm going to throw to you in the middle.
It's such a great question for the last 50 years or longer. I came to the conclusion about 30 years ago that on the question, is gold a currency or a commodity, it reversed to a point where all currencies are commodities. And when I say that, if a government or an authority oversupplies currency relative to population growth and GDP growth, then the currency will behave itself like a commodity, where the currency drops in value relative to the people who care about that currency. Likewise, if the currency and the government is running the economy in a manner where the currency per head of population is reducing, then the value of that currency will rise. Best simple example that I can give you is Singapore. First time I visited Singapore in 1973 as a child, the currency ratio was 3-to-1. So $1 Australian bought 3 Sing. I was up there 4 weeks ago, and I think it was about 1.2 Australian dollars to buy 1 Sing. And I reckon in 10 or 20 years' time, when we go to Singapore, you'll require 3 Australian dollars to buy 1 Sing. That's a measurement of fiscal responsibility, capability, and the way the government runs the country. Now, when you backtrack that into gold, you do the back math. So let's just pretend that gold is a static, a thing that just simply exists. So as the currency drops, of course, gold will appear to rise. As the currency rises in certain countries, which are very few, then gold will appear to drop. So that's a sort of a foundational level. And in a true sense, in my view, especially going back to Bretton Woods and the reason why Nixon dropped the gold standard in the Vietnam War when the US government ran out of money for the first time, because they simply didn't have enough money to print to buy enough bombs to drop on Vietnam to prosecute their political agenda. They dropped the gold standard. So that's where in gold we trust, with the gold counter in America, they simply dropped that. So it really is a negative measure on the way the governments manage their currencies and their economies. And so I think in Australia we're leading the charge on dropping the value of Australian dollar with our policies, shutting down the country for 2 years for COVID. Pick any agenda you want politically. We need to borrow more money to buy more votes on the next state or federal election. We are leading the charge in dropping the value of our currency. Therefore, gold will continue to rise. So the question then becomes, well, who's winning the race in terms of dropping the value of their currency, and their electorate is going to re-elect them in 2 or 3 years' time. So I think gold's going up by at least, you can do the math on the net inflation rate. I think Headley would have sort of characterised it beautifully with negative inflation with interest rates versus inflation rate here in Australia. Gold's going to keep going up. And then if you actually get a scare, a war, a fear factor, then the money will move very quickly into gold, and you'll see that period of outperformance relative to an underlying 3 or 5 or 10% per annum relative performance.
Andrew?
Yeah, I hope the forecast of a bit below 2,000 is wrong. It's a gold explorer. I hope it's wrong. But look, I don't think I can add too much. I think the fundamental macro environment, as we're seeing around the world, hasn't really changed that much in the 12 months. I think a little bit of shift about the fundamentals, but overall, internally, we talk about a higher gold price like Andrew going forwards, and I think we'll see that. I don't think we'll see a breakout that some people have suggested. I love it when people talk about $3,000, but I don't think that's ever going to happen. But we definitely see it returning above 2,000 in the second half of the year, with an eye on what happens with the US next year. We're very quickly turning around to a presidential cycle again, and I'm sure Wood Mackenzie and others are starting to work out what that might mean. But no, we definitely see strong pricing for gold going forwards.
While we've got your mic in the air, I'm just going to get you to double down here and, sorry, while you've got your mic in the air, Mike, I'm just going to get you to double down on the impacts you see inflation, high interest rates are having in the gold space right now.
Well, that one's a tough one for me.
Should we throw that over to Sagar?
Yeah, I think so. We'll get his opinion, I think, next. As an explorer, we'll probably talk about this later, we're not seeing the high gold prices flow through to market sentiment. Now, whether that's driven by inflation and other things, or just the amount of loose change people have around, but we're definitely not seeing at the retail small end of the sector high liquidities. And I've never done analysis, someone should, but my gut feeling is liquidity in stocks across the world in smaller gold companies is down. And that's probably driven by concerns about those, microeconomic issues of inflation, cost of living, uncertainty about going forwards. That would be my sense.
Yeah, I think that's pretty much one of the major reasons is that, for sure. I mean, we saw 2022, we had a lot of producers across the board, irrespective of their size. They were struggling to meet their cost guidance, and that was when it was revised multiple times. So you can get a sense that whatever understanding of their was of inflation at that time, I mean, the reality turned out to be even worse than that. So they struggled in all cost buckets, like labor, consumables, you name it, like power and diesel. And I was in Perth last year in November, and I met a couple of clients and miners, and they were all saying that, we're struggling with the labor cost the most, and that's, they're saying that contractor rates are getting refreshed in a matter of weeks. So I think for 2023, they are still anticipating higher prices, like they're expecting the consumable prices and all to be slightly better. I mean, they're still elevated, but slightly better because of better supply chains. But I think labor is what they are most concerned about. Labor costs, they tend to be a bit more sticky. So I think right now what the companies are doing is that they're just trying to focus on the productivity. And in our data, we saw the peaks of, we've also seen a cost-based revision, upwards. Like we saw that the last peaks, as per our data, was achieved in 2013. So we have surpassed that by now. So we see that a lot of sustaining capital has been curtailed back because of the fact that costs are going a little out of control right now, and that's where they're trying to focus. So, last time when we entered the bear market, say around 2013, that time around, we saw similar curtailments in sustaining capital, but at that time it was because of the prices. But now prices are pretty much, at all-time highs, I would say. We have had, around 1800 average prices for 2020 and 2021 and 2022. So prices are pretty strong, but it's just that this time the costs are really biting into their budget, and they're trying to kind of hold it back. And we're seeing that because projects are getting delayed, both greenfields and brownfields. And you're looking at even big miners like, say, a Newmont saying that they want to invest in their project in Peru in 2024. That's a $2.5 billion investment. That's a big one. But they're trying to delay it so that they can get better economic conditions, and then they can look at their project expansion.
Andrew, I saw some nods from you. How do you see inflation and higher interest rates impacting the gold space?
Again, a fantastic question for the last 30 or 40 years in my life. I saw a wonderful presentation a few weeks ago by Sean Rosso at Noah's Rule in Sydney. And Sean put up, amongst other things, a slide that showed the gold price relative to as literally a physical commodity price, relative to gold equities. And what he showed is over the last 40 years, gold equities are now trading at the lowest value on a gold per ounce equivalent relative to the gold price. There's a little bit of speculation as to why that might be, or how did that come about. And the sort of conversation that erupted was the notion that inflation and the cost of mining gold, which we used to optimise pits, and I've been in the gold mining industry more or less for the last 30, 40 years. We would optimise pits and so on and so forth at $500 an ounce, $600 an ounce and so on. But we'd make 50 or $100 an ounce on the mine feasibility or whatever. Now gold price at Aussie, $3,000 an ounce. There's more than a few gold producers where their inflation, the cost of producing gold, is now $4,000 or $3,500 an ounce. Guess what happens after a few quarters? They go out of business, they're bankrupt or whatever. For the investor to be able to pick those stocks, winners and losers, it's a risk. And so therefore, gold equities have almost collapsed. So that was one aspect to it in the industry. One might say that the CPI and the inflation rate as reported by our governments to our people are understated at 4, 5, 6% inflation rate. I don't know about you folks, but I just got told last week I've got a 30% increase on my rent on my apartment in Perth. 30% is not 4 or 5%. And that's a major cost of living to pay the rent. Mortgages are up 100%, from 2.5%, 3% 2 years ago to now 5.5% mortgage rates. That's not 3 or 4%. So to a degree, I think the gold industry is sort of caught in this sort of misconception, if you like, on what true inflation is. True inflation is not 5 or 6%. It's a lot more than that. gold price at $3,000 an ounce is still inadequate as a reflection of underlying inflation, which is not 5%, it's a lot more than that. That's been going on for a long time. So I'm still optimistic or confident that gold price will keep rising, because I think our governments are underrepresenting or understating what the true inflation rate is, because they've got elections, motivations and so on to run with. It's very positive for gold, and it's, I guess you could say I'm a currency bear, which equally a currency bear equals positive on gold, because no government in the history of the world has been able to control or manipulate gold on its own. It is truly a global commodity, and it's a payable, been recognised by many cultures over the last 4,000 years. So it's going to be very interesting, but I think gold has to go up. The South African gold mining industry has almost collapsed. It used to do 800, 900 tonne a year for decades. What's it down to now? 150 tonne a year. Australia's still holding around 300 tonne a year, Canada, US, etc. But yeah, you look at what's happening globally, and it's all very positive for gold and very negative for currencies.
Andrew, I'm going to start this next question with you. Now, we're sort of sticking on the macro picture for gold right for this question, and then we're going to move into the more mining-related questions of today's Gold Chat. Now, the World Gold Council recently noted that institutional demand for precious metals has actually softened since the end of 2022. However, those clients remain sticky, and it appears that retail investors are actually increasing their purchase of small bar denominations. Now, the problem is institutional demand hasn't just dipped away from the overall gold market, it's also shying away from gold explorers. So tell me, how can we encourage institutional demand to come back into the gold part of the gold exploration part of the sector?
Insto demand has been tricky for many decades, and I mean, I think Warren Buffett most famously said 30 years ago maybe that there's no yield on gold stocks. It's all capital growth. It's drilling for ounces. The gold companies report losses or break even. There's no fully franked dividend yields, etc., etc. And I think Warren Buffett's comments there, I'm just guessing 30 years ago, had a prevailing effect on gold investment. On the flip side though, if you're, as I've clearly indicated, a currency bear, I could buy a bar of gold and it has a physical asset value. I've got it in my hand, I can take it home. But at the same time, that gold itself does not yield like a fully franked dividend. And also at the same time, that gold doesn't grow. It doesn't go from 1 ounce to 1.1 ounces. The beauty of junior explorers is we can start off literally with nothing in the ground, except some hope, some aspirations, some indication of gold. And we could drill 10 holes and we might think there's 10,000 ounces. We could drill 100 holes and we might think there's 500,000 ounces. And when I say we think, you do the geometry, the G6, the resource definitions under JORC and 43101, etc. codes, you know, with very strict discipline. And okay, we've gone from 0 to 100,000 ounces to 500,000 ounces to 1 million ounces. Well, 1 million ounces of gold times $3,000 an ounce is $3 billion of revenue. I mean, you can do that in 2 years flat in Australia especially, or other parts of the world. And in Australia, you know, hopefully country risk is relatively low, so you go from 0 to $3 billion. And that's a capital investment of $3, $5, $10 million worth of drilling. So the reward potential is, fantastic. I mean, it's almost second to none. And you might say, oh my God, I can do a tech company and I can develop the new, technology for silicon chips or memory or AI. Great, awesome. But there's 100 other companies doing the same thing and you don't know about it. As a company in Australia with land or Canada or Africa or wherever, if you own the ground and you've got the gold, you can put that and you can disclose it to the stock exchange under strict controls. You can't make up things. It has to be factually supported. And investors can say, oh my God, we are on that trajectory where we're going from 0 to 1 million ounces in 3 or 4 years. So it's a fantastic opportunity for people to make money. And we don't really have to speculate. We don't need gold to go from $3,000 an ounce to $4,000. You just need the gold price just to actually almost do nothing in the exploration game.
Andrew, over to you. What do you think the catalyst will be to see institutional demand be attracted to junior gold explorers?
Yeah, I'm going to take a punt at this, but my guess is the institutions have probably got a little bit lazy. They will carry enough gold to be a hedge or a buffer in their portfolios, but they, as Andrew has talked about, there's a lot of upside in gold, but they're not doing the work. That discretionary funds is going elsewhere, which is a bit contrary because you've seen, ETFs, and, I'm not going to do an advert for someone, but a Western Australian gold fund is doing very well as a gold fund because they must be doing something right. So I think there's a bit of yin and yang here. The big institutions have definitely taken their discretionary investments elsewhere because it's probably easier, but there's still a lot of upside in looking at gold as a pure investment with the proper strategy and the right research and picking your right portfolio.
Sagar, over to you.
I think I don't really have a lot to add on these points because obviously gold demand is not something that we look into very closely because it's really a tough thing to be forecasting. But I think where because we had so many sessions today around the battery raw materials, and there is a lot of emphasis that these are opportunities where you will create a lot of wealth. So investors are obviously very excited about these these sectors, and that's where maybe the money is flowing in. But I think what gold is, that gold never is something that, at least in my opinion, it's not something that's being advertised as it'll make you rich. But I think it'll keep you there if you do become rich. So I think to Andrew's point on Warren Buffett, I think Warren Buffett doesn't need a lot of protection in his portfolio and stuff, so he can say whatever he wants to say. He's much ahead of the game. But I do think that it's only now that the demand has gone down in the first quarter of 23. But if you look at last year, there was a flight to quality, and there was institutional demand was up, and retail demand was slightly depressed. But now I think the tables are turning. So now retail demand is going up and the institutional demand is going a little low. And I think that's where a lot of emphasis is not, it should be laid on that. Retail demand obviously acts as a big chunk, like 50% of gold is into jewelry, right? And India and China are two countries which are really massive into gold. So you see that people, in the beginning try to kind of avoid gold when the prices are going up, but then after some time the psyche kind of develops that, okay, this is where the new price is, so let's start buying now. So any drip in prices become buying opportunities. So if the institutional demand kind of tapers off a little bit, then I think the retail demand picks up. Yeah.
Now, Sagar, I'm going to throw this next question and start with you, simply because you did actually just start to touch on what I'm going to talk about. Now, battery metals and companies working towards decarbonisation continue to attract a lot of attention, as well as a lot of dollars in markets right now. So what I want to know is, how do gold miners and explorers attract shareholders and investment when the energy transition narrative continues to dominate headlines?
I think we've talked about this beforehand, that where the world is heading, how we see the risks. Like Andrew talked about how he's a currency bear and a commodity bull. if I can say that. So the idea is that as I said before, that there is a lot of excitement in this space, and rightly so. Even we at Wood Mackenzie believe that without these metals you will not have the transition. So there is a lot of value in these kinds of metals, like the BRMs, and so on, like so many of them. But I think gold has that place because it does provide you, it provides you protection when the world becomes risky, when there is a war that breaks out, when there is when we saw what happened with the Russia-Ukraine war. We saw what happened when, as soon as SVB collapsed, the first thing that went up was gold. So I think, and also I think commodities can also be thought as cyclical, right? So what will happen when the cycle will turn? Right now we think that, okay, so it's a super cycle, and the commodities like lithium and all will really go up, which I think is fair. But then what happens when things become rough? That's where I think gold comes in and plays its role.
Andrew?
I wouldn't add anything more. I think we've really covered that. Macroeconomics is going to continue to drive a demand for gold, and we'll see that prop up all the way through currencies. But the other side is, don't forget, a bit of gold goes into the new critical minerals going forwards. We all need the gold in electronics and whatever. So there's still a small demand. So I still think gold is a critical mineral going forwards.
Now, just to confuse the audience, I actually mean Andrew in the middle, but I was making eye contact with Mike when I threw over. Second, Andrew.
Well, given my declared position as a currency bear, battery minerals will do well, you know, from a commodity price point of view, and especially things like LME traded, you know, copper, the headline sort of commodities. Because if currency is going down, of course, they too will rise. I think the overlay I might add is, at least from my perspective, I'm still seeing opportunities where you can find gold prospects or gold opportunities in the ground, more from a geological point of view. And all you need to do is drill out 500 metres or 1,000 metres or 50 metres or 100 metres deep. And when you find a gold system that's got good, robust mineralisation, for the sake of a couple of $1 million you can invest, and you can end up with $1 billion worth of potential resource or reserve opportunity. The share market, that's a fickle beast, and sometimes it's a bear market. And even though you're doing that, which has been the case, I think, for the last 2 years, I've seen God knows how many companies come out with great results indicating million ounces, $1 billion worth of gold. Share price has gone down, 50 million market cap, etc., etc. Go back to my earlier comments about Sean Russo on his presentation slide there a couple of weeks ago. And that's just like, it's one of the best investment opportunities I've seen, because the arbitrage between physical at this price and the actual equity being so depressed, while the cheapest gold you can get is in the ground at $200, $300 an ounce instead of paying $3,000 for the finished product. So there's that flavour. Whereas if you're playing lithium or other battery commodities, manganese or copper or so on, it's a lot more capital, it's a lot more risk money on drilling. It's $5 million, it's $10 million, it's $20 million worth of drilling. Drilling deep brine wells in the US of A, you know, $5 million, $10 million for a well. You got brine, great. How do you get it out? So there's a differential there. So I think even with the popularity of battery metals, which is awesome and a great opportunity, have it in your portfolio for sure. Gold, get the right play, get the right ground, get the right sort of flavour of mineralisation or indications of mineralisation. Find a cheap stock that no one likes. That's the one you should buy. And there's plenty of those.
I'm going to come back to that point in a second, Andrew, but first over to Sagar.
Sorry.
How do we get investors to invest in gold and encourage that away from battery metals?
I think if you look at gold, I mean, gold is scattered across the world, right? There's gold mining in Canada, US, Australia, Africa, West Africa is really coming up. So when you look at some of these metals, like, you know, in the earlier presentation, there was an emphasis on how Indonesia is the biggest player for nickel, and then cobalt is either Indonesia or DRC. So, and all of these countries, not all of these, some of these countries are also looking at things like nationalizing their lithium reserves and all. So that is something which will, you know, which will create less opportunities for investors to go into that space, because if the governments are stepping in and taking a bigger piece for themselves, so investors will obviously need more opportunities to be investing. I mean, we don't see that kind of nationalization kind of a thing for gold, obviously, but we have started seeing that gold is also kind of doing slightly in that area, like a country like Mali in Western Africa, they are kind of renewing their contracts and they're trying to get a bigger piece for themselves than the companies who are operating there. But I still feel that there will be more opportunities for investors to invest in gold, I mean, simply because there is a lot of it, you know, around the world. I mean, opportunities for investment. I'm not trying to say that there is a lot of gold out there, but I'm just saying that opportunities are quite a lot.
Now, all three of you actually sort of half answered my next question, so I'm unfairly going to throw a lightning round on these guys, so you've got to give me a really short, sharp answer. Mike, I'm going to start with you at the end. What is the one thing that investors should look for when looking for a potential junior explorer?
I'll give you two. I've got to say one, Novo Resources.
Of course.
Right? That's obviously the best place to go. So one. Ooh. All right. I'm going to go.
Is there a key to unlock?
Yeah. No, I would go at the top of the tree. So really understand the board and the exploration team. And, you know, you want a team that has global experience across a range of different geologies and a team that have demonstrated success, but importantly, a team where the management and the board work together on a common strategy and rationale. So number one, look at the team.
Excellent answer, and I feel that very much reflects Novo's management and board.
Spot on.
Andrew, now we're not allowed to have favourites in this game, but you do have a prospect in one of my favourite areas, which is the Central Victorian goldfields, which I've been calling the Gold Rush Renaissance. Tell me, what is your one thing that investors should look for when it comes to a junior explorer or a gold explorer? Let's be specific.
First thing, agree with Mike. Second thing, my thing, is geology. Just line up the drill targets, line up the reef, line up the system, line up whatever it is, a porphyry, a geological system, and here's evidence that there's gold in that area. And then line up the drill rig. You got the money, start drilling, and then the rest will follow.
Yeah. Not just that, don't confuse geology with geography. Right?
Ooh.
A lot of us, you know, a lot of people chase neurology. But that's about geography and not necessarily geology.
I really like that answer. Sagar.
My pick would be, not but just because I have to say something different to what what these two have already said, I think would be jurisdiction. So where are you looking at the project? Like what country are you looking at? And like, for example, I see that, for example, even in Mexico, they're rehauling the whole mining code. So again, there is in PNG, Barracks faced that problem that, the government didn't renew the license of Pilbara. So the idea is that if you are in a relatively stable jurisdiction, if you understand that, okay, this country is not trying to, create challenges for companies operating on their land, I think that also has a lot of impact on what kind of growth are you looking at, what kind of, will you be able to get your, biggest bang for your buck. So I think for me, geography is also very important.
Now I'm going to start with you for this question, Andrew. Now we have touched on driving institutional demand back to gold, but the problem is retail markets haven't really followed the commodity price up right now. So how are explorers going to fund some of these ambitious projects when the tap's not there when we try to turn it on for capital raisings this year?
Totally. I think the last piece of a previous question was, well, certainly an observation that I think I shared with a few people a couple of years ago. When the COVID lockdowns occurred, the Australian government threw money around to people for being locked down and so on and so forth. Within weeks, we saw junior gold explorers. Just the share prices started to go up dramatically. And I think what was happening then was the availability of liquidity, i.e. cash. People sitting at home, what do I do? And they're on their NAB trade or their ComSec or whatever accounts, literally punting gold stocks. And as soon as a bit of momentum came into those gold stocks, it just took off. And there were 5 and 10 baggers, literally, in a matter of weeks and months during that period. And then, of course, the government said, well, the money tap we're turning off and so on and so forth over the next 3 months, and that came down. So I guess the point of sharing that story with you is that the injection of liquidity into individual people's pockets, plus the uncertainty or the time available to punt stocks and look at their screens and all the rest of it, really drove a mini gold boom at that time. Since then, it's all been downhill. Gold stocks are down 90%. Since that period in history in Australia. And where do we go from here? What's the next injection of liquidity that's going to drive the next retail boom? I don't know. I think it's back to the old capital markets, the survival of the fittest, and you need the best looking prospects, the best looking grade near surface, the ability to drill and deliver not just drill results, but then resources and more resources and increases. And, you really are fighting for that position in the game. And then also you need good marketing, and that's, I think, why we're here today, is we need to market. We can't just achieve this and announce it on the ASX when there's 2,000 junior companies and the noise factor is very loud. How do you get attention? How do you say, well, pick me and my thing's good? At the same time, from an investor point of view, it's a fantastic opportunity. If you've got the time to sift through everything, you'll find things that are massively underpriced today. Like when I say massively underpriced, they're 10, 20-fold. But there's no analysis, there's little or no research, very few broker research reports. Even if you get one, so what? It's just one. You really are on your own as an investor. So I think there's some real challenges for companies and investors alike.
Mike?
Yeah, I think Andrew's covered a lot of the comments I'd make, is that the independent investor has disappeared out of the gold sector. Those investors that can tag along because they've got books with some of the bigger broking houses and see a bit of research or support from the broking houses are still investing in gold, but it's the smaller guys that aren't there. And as Andrew said, there's a lot of us. There's a lot of juniors on the market. I actually think we're going to move into a different space with the gold sector, and that the explorers will merge. We can't all do what we want to do. Number one is we can't find the geologists to do what we want to do, let alone the equity. So I think we've seen the M&A happen with the producers, but I think you will see the same with smaller juniors, because we just can't all get the money that we need to put in the ground. I actually think that'll be a good thing. I think that'll drive a bit more rational thought on what we're doing in exploration, and probably drive us up the technology curve and be more selective and ultimately be more successful, which will move us in the right direction. But yeah, junior sector is very difficult. The Australian sector is better than the TSX, I can tell you from experience. Australia is still probably the best place to go exploring for gold, jurisdiction, geology, access, all of those things, and costs, but it's pretty hard to get discretionary funds from individual investors. And as Andrew said, they don't have time to go looking for that, and they see the biggest bubble somewhere else and they'll chase that. Yeah.
Sagar, over to you. How do you see retail investors coming back into this space?
I think when you look at, I think one thing that's a little overlooked is the fact that a lot of these producers are struggling with short mine life, right? So some of the producers out there which will practically, might just get out of business in the next 5 to 7 years. So a lot of these exploration companies have a lot of potential where they can at least, there have been deals in the past. There were recently deals announced by the big ones like Newmont and Barrick with these explorers that they find that they have potential, because they're also struggling with production growth, right? If they're not struggling with end of mine life operations, they are struggling with production growth. So they can't grow their production. They can't always do M&A. So they will have to invest in an exploration company which they feel will have potential, so they can get on board and kind of support them in the development of that mine, because they'll bring in the expertise and the experience, and they can't be exploring everywhere. So I think a lot of times investors, if they're aware of this fact that the shortening mine life is a big problem for the industry, so that's where I think junior explorers can also do a lot of good for the industry and for their shareholders. And who knows, you might also catch the eye of one of the big producers. It has happened. It's not like it's not. Just right now we saw Goldfields acquire this company in Canada called, it's a project called Windfall Lake. So because they could not go ahead with their acquisition of Yamana, so they went ahead and got exposure to another asset in the country in which they wanted to enter, which is Canada. So it happens all the time. It's just that you need to be aware of it.
I've got one more question for the team, and if you guys have questions, we are going to take questions afterwards. Now, Sagar, I'll stay with you. Now, brownfield development has been quite popular among the gold sector, really for the last 5 years, perhaps even longer, and greenfield projects have really struggled to attract funds. Now, tell me, overall, is this the market dictating that they'd rather put money into a known mine? Do you think overall that the market is scared of investing in the unknown risk?
I think it's a lot to do with what happened. There's a bit of historical perspective here. When in the start of the millennium, there was a lot of excitement around gold, and the reserve prices were very flexible, very elastic. So they were like pretty high. There was a lot of optimism, and then all of that crashed when the prices corrected, right? So shareholders are obviously trying at their best that at that time gold got a reputation of being a wasteful sector, and and they lost a lot of shareholder confidence, and that's when they stopped exploring quite a bit, and they felt that, okay, let's just work on the cost, let's just pay back our debt, which is actually creating the problem of the shortening of mine lives. But at the same time, right now I think shareholders are very cautious as to where they're spending the money. Are they going to splurge on M&A, which they're not very which they don't want because they have been burnt in the past, so they're trying to be more cautious. And I think when you look at, brownfield is the best, bang for your buck, because you already have an operation, you already have your mill. If you can go out there and get some more stuff, then, and that's what we have seen in the past couple of years, because of the prices which are at such good levels for gold. There have been a lot of deposits which could have ended in the past 2 years or 3 years, but because of the prices, they've been given a lease on their life. So I think we see a lot of brownfield, a lot of optimism in that respect, that because the prices are well supported, companies think that they can perhaps, get the stuff out quicker and, rather than going for an expensive M&A.
Andrew, now I'm going to slightly alter this question for you. Now, you're exploring for gold in an area that has been prospected, I guess you could say, but not well explored. Tell me, are you finding that investors are attracted to this story as opposed to doing the same old thing, and that is pumping money into a brownfield site?
In the current market, I would say there's little, if any, enthusiasm for greenfield exploration. I think the question under the question is the speed at which you can progress or develop into cash flow. And so just listening to the last minute or two, I was just reflecting on a letter that I saw on a placard, on a frame in an office in West Perth about 30 years ago. And it was a letter from the managing director of Rothschild's Bank to a small company and an entrepreneur in West Perth. And the letter was, "Dear Mr. So-and-so, lovely to meet you last week. Take it from this letter that Rothschild's Bank of Australia is willing to underwrite and provide finance for $10 million as and when you need it to build a plant and take your gold discovery into production," which all happened in about 24 months flat. And it's like, wow. So from drill hole, first announcement, first discovery in the mid-1980s, these guys were building a min-proc gold plant, the Greenie Meenie, and had another 50 drill holes into it, and they were producing gold at 20, 30, 40,000 ounces a year with a 3-year mine life or whatever it was, on $10 million from a letter from Rothschild's just saying, well, we really enjoyed our lunch and we're very optimistic that we'll get our $10 million plus interest back as Rothschild's Bank of Australia. And that was kind of the way it was rolling back then. So I think the question with greenfields versus brownfields is, well, if it's brownfields, you're near a plant or you're close by proximity and you're taking out a lot of the time and capital cost risk. Back there in the day, in the 80s in the West Australia goldfields, and a big part of the success, and then Kidston Gold Mines and Mount Lation in Queensland and so on, sort of were close on the back of that. Investors could put their money into the first drill holes and they could almost expect to see a dividend in 2 to 3 years flat, plus all the happiness and joy of production and positive announcements for that 3-year period. And now we've got an environment which is 5-10 years or whatever it is. So I think brownfields shortens the time frame, from an investor perspective, genuinely so. Greenfields, though, you can come up with. Australia really missed out on it with the Patterson range. I think in West Australia they're up near Telfer, Kimberley / whatever. Patterson range is, who knows, 5 million, 10 million, 50 million ounces of discovery, but Australian junior investors have hardly participated in that. Some of the things in the Pilbara, of course, 1, 2, 5, 10 million ounce discoveries have been awesome, and Australians have participated in that. But then you've still got this 5 years, and is it going to cost you $10 million or $200 million? And then as a junior company, 50 million market cap, who's going to give you $200 million to build the mine? So there's significant questions from an investor point of view. And the whole thing's it's really gone into a challenging phase. And then, okay, corporate takeout, or let's get a takeover. What do you do? How do you manage your company? Which direction you take it? So I think the jury's out. I think there's still greenfields and brownfields, and there's, depending on the conditions, there's opportunities for investors in both patches.
Mike, I'm going to slightly tailor this conversation for you because I know how exciting what Novo Resources did was out in the Pilbara. Tell me, how did you convince shareholders to take on that risk? Because while the Pilbara was a known mining province, it wasn't really famous for gold.
Yeah, and I think that's kind of part of the miss story. So if I went another way, I'd say there is investment for greenfields exploration, but it's probably targeted very different to the past. If greenfields is like next to another existing operation, neurology, I actually think greenfields is something kind of unique. And if you've got a good story and a good team, I think you will always get investment for proper greenfields exploration. And the Pilbara is interesting. I can just think of, if you take the De Grey story, if you look at the backstory, there'd previously been mining in those tenements and those areas. Even if I would go further south of the Pilbara, where Kalra is at the moment with their Mount York project, that's a previous gold district that's expanded. Where we are at Nullagine, it's the same. So across the Pilbara, there has been a lot of gold exploration in the past, but it was overrun by the stories of iron ore. The geology is a lot different and more complex. So probably my short answer would be, for greenfields, you need to build the business case or the exploration case and the rationale properly for people to invest. I think you do actually need a champion to get you past that first, whether that's an institution or private net worth or something. You need that sponsor to get you to get drill holes in the ground, and once you've got that and success, it'll flow. But it is hard to get that, inverted commas, seed money to get going as greenfields. And that's why, as I said before, I think at the end our explorers need to join together, because that seed money is not there to do pure greenfields where no one has been before. Quite difficult.
Gentlemen, thank you for today's discussion. It's been fantastic. If the audience has any questions they'd like to ask any of the three up here.
Hi, thank you so much for your conversation. This is more of a, I think what I understand from Sagar, from what Mackenzie is, his prediction is 1900 for 2023.
Yeah.
And in your analysis, have you considered international geopolitical risk? The reason for that is BRICS, they are getting much more stronger in terms of their bonding. 5 different countries, 5 different languages, 5 different culture. How do you communicate?
So,
gold?
yeah, so I think that's something that I maybe should have said at that time. So so when we talk about gold price, because we don't cover gold demand, so it's not really based on any econometric modeling perspective. And I think gold price becomes a bit of a challenge when you are trying to say that it's going to be, around 2,500 by this year. because the forces that determine the gold price are mostly, if not always, outside of your control, and because you will not know if there is a war that breaks out tomorrow. Nobody knew about, I mean, people had an idea, but nobody knew that Russia would attack Ukraine, right? Nobody knew the pandemic would come in. So I think it becomes a bit of a, I would say, for lack of a better term, I think any estimate out there is based on some side of upside or downside risks. Like ours is just based on our understanding of the market and the various forces which are contributing to the growth in the price. But in the beginning, as Mike said, that he feels that 1900 is we are underplaying it, which could totally be the case. I mean, it's hard to have a lot of confidence on your gold price estimate, and that's why we at Wood Mackenzie focus on the supply side. We look at projects, we look at miners, what they are doing, because demand again is something that's really complicated. You have a lot of, I mean, to some extent, even supply is complicated because you have a lot of artisanal mining, you have a lot of informal mining, you have a lot of mining that's been done in areas where nobody knows what's really going on in those countries or in those regions. So I think price is certainly very tricky for gold to kind of have a confidence, like, okay, 99% confidence it will be in the range of 1900 to 2000. And if you read surveys, like, LBMA does a survey of analysts. So if you just go through that list, you will see that there are all these analysts over there who are forecasting their price. But again, when you see their actuals and compare it with previous years' estimates of those analysts, you will find that some of them were really wrong, and some of them were within plus minus 10%, but some of them were like completely off.
Thank you very much. Is there anybody else? Thank you very much for joining us here today. You guys have been fantastic.